Okay, let's go ahead and get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the broader market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Also, a big thank you to all the nice messages. Yes, I did come back from honeymoon yesterday, so it was a great 2 weeks away, but happy to be back and hosting this webinar. So our agenda for today, we'll be kicking off with our major equity indices. We've seen quite a bit of movement in the last 2 weeks. First week I was away, we had a lot of bullish movement, and then the second week, a bit of consolidation, but still very much in a bullish undertone. So market structure has clearly broken to the upside, as it has for the last few weeks. We have been in our risk-on environment, and we'll take a look at where potentially the major indices could move towards. Okay, from there, we'll be moving on to fixed income and commodities. We'll also take a look at the sector rotational model, looking at the daily sector rotational model for today's webinar. We'll take a look at a few subsectors of interest, and as usual, ending today's webinar with some bullish and bearish market observations. Oh, wow. I think my, that's very strange. Do you know what? I think it didn't save my slide deck, but what I'll do here is actually share my chart setup here. Apologies for that. I'm sure I saved it, but anyway, what we have here is the S&P 500. So looking at the SPY ETF. And we've seen a lot of bullish price action really since around end of October, price breaking above multiple areas of resistance. And even more recently, that breaking above the 450, 455 level of resistance, but running into 460. So there is some resistance that price is reacting to. Momentum was very much touching an overbought condition, starting to decline ever so slightly, but price continuing to move higher. So that indicates that there is still a lot of underlying momentum left here for equities to continue higher, which is in line with our overall thesis. But I do expect maybe some more consolidation here for this week, and maybe even a slight pullback. The reason for that is because when we look at the macro impacts of what's, or the macro themes of what's causing markets to move right now, it really has to do, once again, with the Fed. But more specifically, it's the fact that markets or investors are pricing in a more dovish Fed. They're pricing in the fact that next week's Fed meeting, we may only see the Fed keeping interest rates neutral instead of hiking them, which is going to act as a strong tailwind for equities. But also, they're expecting that the Fed will start cutting interest rates a lot earlier than March of next year, which is what was originally anticipated. So that is why we've seen such bullish moves here in equity markets in the major indices, but it also does lead to a slight vulnerability, in my opinion. And the reason I say that is because we know the Fed is data dependent, and we know that data, well, it has very much been coming in highlighting the fact that inflation is coming down to the Fed's expectations. One or two bad pieces of data could very well see equities decline a lot more than expected. Now, the next major piece of data that we do have coming out is non-farm payrolls this Friday. So I expect to see some consolidation there ahead of that non-farm payrolls announcement. And from there, next week is always going to be about the Fed meeting. So there is definitely more room for consolidation over the next week. But that may be a good thing, because if you look at the charts, not just the major indices, but a lot of the individual stocks itself, you'll see that the price structure is very similar to what we're seeing here for the S&P 500, where it's approached an overextended, overbought condition. Momentum is very close to being overbought or is already at an overbought condition. And more consolidation with more consolidation, we may see momentum decline to more modest levels and therefore provide a much better risk reward bullish entry point. Our overall thesis and a longer term thesis is still bullish. We do expect to see price reaching the 480 level in the next few weeks, because at the end of the day, the Fed is going to be cutting interest rates quite soon. Only question is, are they going to do that in March or earlier or later, obviously, depending on the data. But in terms of pullbacks, instead of consolidation, if we do get a pullback, I do potentially see price retracing towards a 21-day exponential moving average. That's one area that I am looking at for potential pullback. I think pullbacks will be very, very limited. I mean, look at the underlying momentum behind this initial move here for the S&P 500. Okay, moving on to the Qs, the NASDAQ 100. So it has actually been underperforming the S&P 500 because we've seen in the last few days rotation out of the technology, and the NASDAQ 100 sector is very much heavy on technology. So we've seen a slight underperformance despite, generally speaking, outperformance for the year. Price coming back to this 380 level, actually intraday retest yesterday and a bounce higher, but set to open a little bit lower this morning. So it'll be very interesting to see whether price can stay above this 380 area and stay above its 21-day exponential moving average. But like the S&P, I do think pullbacks are going to be somewhat limited. The rotation out of technology isn't going to be lasting forever. And it's also good news that we are seeing rotation out of technology because it indicates broader market participation. Looking at the indicators, looking at my 6-period CCI, which measures short-term momentum, we can see it is at an oversold condition or very close to it. So I don't expect this decline to last too much longer. In terms of key levels, a break below this 380 area, we had the 55-day exponential moving average to provide some support. And the next key level to the upside really is all-time highs at around that 405, 406 area. Okay, looking at IWM, the Russell 2000 ETF, and this is where things are getting a little bit interesting. And, it's been a long time that I've been doing these market outlooks, but for the majority of them, I'm sure I've said we have seen large caps outperforming small caps. However, more recently, we are now seeing small caps outperforming large caps. And of course, we're seeing value outperforming growth, which usually does not happen unless we're in a bit more turmoil. But with small caps outperforming large caps, we've seen that Russell 2000 rally with a lot of momentum heading towards this 188 level, which is 38.2 fib area. And, once again, bouncing from 163, breaking above the 50% fib level at 170, and just showing a lot of momentum. We are now seeing a moving average crossover with a 21-day exponential moving average crossing above the 55-day exponential moving average. The only thing that's a little bit concerning, I wouldn't even use the word concerning, but something that we have to be wary about is the fact that price is at an overbought condition, and it is at an overbought condition at a major level of resistance, which is this 38.2 fib level at 188. So I do expect to see maybe a limited pullback or some consolidation ahead of it. But given the fact that we are in a risk-on environment and market sentiment is pretty positive, we could very well see a breakout and a continuation higher, with the next resistance zone being at around 200. As you can see, major level of resistance on the weekly. And then we have 210, which is a 23.6 fib level. So very obvious key areas to be looking at here for IWM. Okay, TLT, the Treasury Bond ETF. So with yields moving lower, we saw the 10-year yields breaking below 440 basis points. We are seeing bonds across the board move higher. And TLT has now seen its exponential moving average crossover with a 21-day EMA crossing above the 55-day EMA, set to open higher this morning, breaking above 92 as well, which was a minor level of support. Could have potentially acted as resistance. Momentum turning positive. There's a lot of good, positives here to take from TLT. And right now, I'd be looking at bullish opportunities. I know throughout the year, bearish opportunities were the way forward. 108, that was a clear resistance level that we could short from, and we were able to short TLT along this decline. However, with the macro conditions the way they are, with yields declining and with a more dovish Fed, it makes more sense to now look for bullish positions in bond ETFs or bonds like TLT. So next key levels that I'm looking at is really that $100 level. There isn't a strong area of support or resistance. You could argue maybe the 97.50 could act as a minor level. We'll see about that. But for now, I am looking at 100 as the next key area. Okay, the US dollar. So US dollar has seen some improvement in terms of its momentum. It was quite oversold for quite some time, but it's still below its 21-day exponential moving average. So what we are seeing here is clearly capitulation. We saw a strong recovery here due to a more perceived to be hawkish Fed. We are seeing a bit of capitulation at 107.50 and now price breaking below that 105.50 level as well. Key level to be looking at because that was a significant breakdown and it does indicate a shift in sentiment for the dollar to a more bearish tone. So could the dollar continue a little bit higher? I do think so, especially with this with price being a little bit on the oversold side, but I think upside here would be limited. Even once it starts reaching its 21 or 55-day exponential moving averages, that's when you could see a potential reversal point for the US dollar. The macro and fundamental outlook for the USD is definitely to the downside. And the next major level that we have here is the $100 level. And taking a look at light crude oil, sorry, that's gold. I apologize for my slide deck. I just don't think it's saved from the last time I used it. We'll take a look at gold here. So gold, very interesting position here for gold. As you can see, price reacting to this 192 major level, triple top forming, and this week started off on a bearish note. So price clearly respecting this level of resistance. Question is for how long, or is it permanent? We know with geopolitical tensions, gold as a safe haven will continue to move higher. We know with a weak US dollar, gold will move higher. And with a weak, because of the Fed being a bit more hawkish, that's leading to a weaker US dollar. That's another reason for gold to continue to move higher. However, this pullback does come at a right time, in my opinion. We can see price was approaching an overbought condition. And it's tricky to really be bearish on gold right now because the fundamentals do point to gold being at elevated prices. However, the technicals are showing that price is a little bit over extended and that we could be moving a little bit lower, at least in the short term. So the way I'd be looking at gold isn't to necessarily trade the decline or the retracement, but to look for bullish opportunities after this retracement. Ideally, 184 would be a great entry point to the upside, but really anywhere between 184 and 186, we are seeing some key levels here, and gold could very well decline back to that level before retesting 192 and potentially even break out higher. And oil. So oil has been on a very strong decline. Ever since, October or so, we saw price really topping out at around the 93 level and then tried to get back up there for a few weeks. Couldn't really get there, didn't have the momentum, and breaking below that 83, 82 area with a lot of bearish momentum, reaching an oversold condition, but still continuing to move lower. We're seeing a minus resistance zone at 80 and some minor support at around 73 to 75, but clearly you can see prices pressuring down on the zone, and there is still some more room for decline back down to daily support at 70. But the key area that I'm looking at is weekly support at 66. I believe there is definitely a lot more room for this oil decline to continue to move lower towards the 66 level. And the big reason for this, it was actually quite difficult to find the reason or why oil is declining. But even though there are supply cuts, which usually increases oil price, it's just that fact that markets are expecting lower global demand, especially for next year. So that is why we are seeing oil prices continuing to decline. Okay, sector rotation. This is actually the daily one. So with the daily sector rotation, the reason I wanted to use this was because we're seeing a lot more frequent changes with markets. We are seeing, like technology has been providing leadership for quite some time, but is now in the weakening category because we are seeing a limited pullback. And we want to look for bullish opportunities with good timing. And that's why I wanted to use this sector rotation chart, the daily time frame. 7 sectors in the improving and leading categories, 4 in the lagging and weakening. So starting off with the leading categories, we actually have real estate, finally providing some leadership after many months of underperformance. We have financials up there as well, along with materials and industrials. So this does indicate broader market participation when, throughout the last few months, whenever we've looked at this chart, these 4 sectors in the leading category have always been in the lagging or the improving category. So good market participation, despite this pullback in technology, I still view this as positive for equities as a whole. I don't believe the weakening in technology or the movement from the leading to the weakening category is cause for concern. I think this is simply a retracement lower because technology has been providing a lot of leadership. We also know that technology is a lot more sensitive than other sectors to interest rates and changes in interest rate policy. So a dovish Fed will definitely be a much bigger tailwind for technology in the months to come. I do expect technology to rotate back into the improving and if not leading category soon enough. Now, if we take a look at the improving category, we have energy, healthcare, utilities, but we also have staples here in the lagging category about to rotate into the improving category. So what's quite interesting is healthcare, utilities, and staples, our defensive sectors, all showing a significant improvement in terms of relative momentum against the broader market. Again, another reason or another clue as to the fact that we are seeing broader market participation. But we have communications, on the other hand, actually rotating lower after providing some leadership for quite some time and actually being quite a strong sector in the last few months. So again, like technology, I don't expect communications to be here for all that long. So moving on to some subsectors of interest, one of the names that I think is quite interesting is DRIV, which is the Autonomous and Electric Vehicle ETF. So what we've seen here is, a fairly range-bound market since for most of the year. Price, finding some support at 21, breaking above 22, and managing to break above its 21 and 55-day exponential moving averages, finding support at 23 and its 55-day exponential moving average. So it is consolidating after this initial move higher. That's our first leg. And this does still provide a good risk to reward for continuation higher towards that 25 level, especially with this consolidation bringing momentum levels lower. So good risk to reward. For those of you that are a bit more conservative, you may want to wait for more bullish confirmation. But I think right now, even utilizing a trade strategy like a credit spread should still yield some beneficial results. That's how I'm viewing DRIV. Taking a look at the JETS airline ETF. So we've looked at airlines now, even before I went away, for the last month or so. And we have seen that price was severely oversold. This provided a good risk reward bullish entry point, and we saw the price is creating a double bottom. That's why we got into this trade. I don't know, it was like 6 weeks ago, a month and a half ago, almost 2 months ago. And since then, it has been performing quite well. Initially slow to kick off, but we saw price breaking above its 21 and 55-day exponential moving averages, initially respecting that $17 resistance level, but we have seen a breakout in recent days, continuing to move higher with strong momentum. This was very much a longer term play. So far it is doing very well for us. We do have some resistance at the $19 level. Actually, I've already highlighted that on the daily time frame. But from there, there's plenty of room to the upside. 21 and 22 would be the next other key areas that I would be looking at. A new idea for today is BMY. So BMY, this is a bullish idea and very similar to the chart that we saw from JETS. Yes, there's no double bottom, but you can see how far low or how far extended price has gone to the downside. And now we are seeing momentum starting to increase on the daily time frame, price starting to level off above 48, and finding that improvement of momentum, that could be a clue to see a reversal higher here for BMY. Now we have a couple of key levels to be looking out for, 54 being the first one, and from there, the $60 level as well, maybe 58 acting as a minor area as well. So BMY, good risk to reward to the upside, but it's looking like a bit of patience here is required, but there are definitely some clues that are aligning to a bounce higher. Okay, Z-scaler. Z-scaler is another bullish idea. We saw a significant decline for Z-scaler, followed by capitulation. You could argue that's a very not so great looking inverted head and shoulders, but there was a neckline break at around that 170 level. Price has since rallied with a lot of momentum. Lots of rejections of the 200 area, indicating a nice pullback, maybe towards its 21-day exponential, 21-day exponential moving average, or a little bit lower. But from there, we're looking for a nice risk to reward bullish entry point. This is a technology name. So once technology as a sector starts to pick up, that's when you could be looking at Z-scaler as a bullish opportunity. Plenty of room to the upside as well. Looking at Allstate, so this is a bearish idea, and if you look at the weekly charts, you can probably see why. Major resistance between 140 and 150, price looking very overextended, but not yet overbought. So we could still see some more movement to the upside in the next couple of weeks, but this is definitely going in my bearish watch list. The risk to reward already at current levels is very tempting for a bearish position here. And of course, you do want to diversify your portfolio when it comes to directional trading. You don't only want to be bullish or only want to be bearish. And I think Allstate, where it's currently trading at, does provide a nice bearish entry point, especially for diversification purposes. Again, because most of the ideas that we've discussed today have been bullish. So let's see how price reacts to 140, 145 over the next few weeks. But I do think we could be pulling the trigger on this soon as a bearish idea. Okay, and another bullish idea is actually Meta. What I like about Meta is the fact that it has pulled back quite significantly. Now almost breaking below its 55-day exponential moving average. Normally, that's not a good thing, but as you can see on the weekly time frame, structure remains robustly bullish. There's more room for price to actually decline towards its 21-week moving average, and it has still been making slightly higher lows there. So the further Meta declines, the more attractive of a bullish opportunity it becomes, and definitely one to add to the bullish watch list. However, maybe wait for additional confirmation on that first. And with that, that is all I have for you today. Thank you so much for joining me. And yeah, it's been great to be back after a break for 2 weeks. So thank you all. I hope you have a great trading week, and I will see you next week, Tuesday, for another market outlook. Goodbye.